I'm joined this morning by Lydia Davidson, who's the head of technical marketing at Brightrock. Brightrock is a needs-matched insurer in the South African context, looking after groups and individuals. Lydia, good morning.
Hi, Chris. Good to be here.
So, Lydia, tell me, risk insurance has been around for a long, long time, and it's kind of siloed and being done in the same way for many, many years. You guys seem to be approaching this from a bit of a different angle. Explain that to us, please.
Sure. So we came to the market in 2012 offering a needs-matched risk insurance offering. And we're doing things a lot differently to what anyone else is. We'll chat a bit more in a few moments about specifically. But one of the things that allowed us to bring needs-matched insurance to the South African market was technology. Computing power as it is today allows us to do many, many, many calculations in a very short period of time. And this means that we can really match clients' cover to the underlying needs that they have, which is really what risk insurance needs to be about, right? McKinsey did a study in 2021 called How Top Tech Trends Will Transform Insurance. And one of the things that they pulled out was that insurers are terribly weighed down by legacy technology and legacy systems. Now, when we started in 2012, we had absolutely none of that. We didn't have these legacy systems holding back our innovative process and making that product development process quite cumbersome and long-winded. So we were able to tap into massive processing and computing power that had never really been available before, and that allowed us to bring innovative products to the South African market.
Right, and obviously the world has changed significantly, because when I came into the industry 30 years ago, we were still using these old bordereau lists. They didn't even go onto a system. You worked out your averages and looked at your average ages, the salaries, the genders, all of that, came up with a rate, and off you go. So very many changes. So Lydia, tell me, why change? What's been broken in the system that we've missed?
So life insurance to now has really been sold on a one-size-fits-all approach. And there's some serious problems with that. The first problem is that people's income protection needs are a lot higher today than what they are the closer they are to retirement. So selling someone a lump sum of disability cover, for argument's sake, is not going to help them when you're giving them the lowest possible amount of cover today in a vehicle that is going to be growing and growing and growing over time to a point where their need, i.e. the need to protect their future incomes, is lower than it's ever been with the highest amount of cover at that time. It just doesn't make sense. Another problem is that people actually recognize this, and working with financial planners, this becomes evident over time, because as you do financial needs analysis for clients, it becomes obvious that they have more cover than what they need. And industry's claim stats will confirm this. People buy down and cancel their cover the closer they get to their retirement age, because they just don't need that amount of cover anymore. What they've done, though, is they've purchased initially cover that was meant to last 25, 30 years and paid a premium for that. Now what's happening is they're keeping that cover for 10 years, 15 years, buying down, canceling, and actually getting to a period where they've wasted a lot of those premiums that were paid. Things could really be done a lot more efficiently. And that's where sort of technologies come in and assisted us. We're able to do calculations for clients as to their current need. So how much do they need today to cover all their future paychecks? And we can do those calculations in a matter of seconds. We can do those future projections. We can use a number of variables and do calculations really quickly to work out for every single month that that person needs cover, how much they need to pay over time, and when that cover is going to come to an end. So yes, technology's really helped us with this. But more than just focusing on technology, it's about the client, it's about the person who needs that cover, and about giving them that cover in the most efficient way possible. And we were doing this for individual clients, like I said, since 2012, but it became obvious that group risk members were in the same boat. They didn't have efficiently priced risk solutions, and that's what we came to the market to do, is to extend that to our group risk members as well.
So Lydia, tell me, how is this a problem on the group risk side?
Well, So typically when employers or funds are creating insurance solutions for groups and schemes, they're giving their members a multiple of annual salary. So you'll see 3 times, 5 times, whatever it is. And on the face of it, it seems quite fair that I get 3 times my annual salary. Maybe I earn more or less than one of my colleagues. They get 3 times their annual salary if they were to become permanently disabled or pass away. And it does kind of sound fair. The problem, though, is if you interrogate it a little more, say you've got 2 members on a scheme, and one member is 25 years old and another member is 60 years old. 3 times an annual salary for a 25-year-old is, if they're sensible, going to get them to 28. They're permanently disabled. They don't have a mechanism for earning an active income. They really can't support themselves for a decent percentage of what they would have expected to be their working life. Now, contrast that to the 60-year-old. If they became disabled and they had 3 times their annual salary, they'd be covered until they'd receive a payout and be able to use that until they were 63. And if their expected retirement age was 65, they're not far short. So you've got a 25-year-old who is grossly underinsured with that approach, and you've got a 60-year-old who's maybe actually okay. They've got almost enough cover. And those two, like I said, on the face of it, seems fair, but on interrogation, grossly unfair, particularly to that younger member. So that's what we wanted to do. We realized that we needed to find a way for that 25-year-old to access the same percentage of their future incomes as their 60-year-old colleague. And that's what we went out to do.
Right. Okay, Lydia, so is there a way that you're going to back these solutions a little bit more for us in detail?
Sure. So what I wanted to start with was our product development process. And there are 3 pillars that we focus on when we're making changes or bringing something new to the market. And that's efficiency, flexibility, and certainty. So on the efficiency front, we want to make sure that every rand spent is spent giving that member and giving that scheme as much cover as possible, as efficiently as possible. For rands spent at scheme level, we can get quite a lot more cover for all of the members on the scheme, sometimes as much as 60% more cover for the same rands spent as on a traditional approach. The next thing that we look at is flexibility. And here there are 2 sides to the flexibility. There's flexibility when someone is a member. So we have a feature called the Extra Cover Buy-Up, where members can actually increase the cover that they have on the scheme without any medical underwriting, so that they can potentially close any personal financial planning gaps that they might have. But then also at claim stage, which is really important to us, whether you're claiming on disability, so the claim payment actually comes to that member, or on death of the member, where the payment is going to beneficiaries or dependents or people that they're leaving behind who are looking for that payment to ensure their financial future, we can actually structure the cover so that in the hands of that person receiving the payment, you can choose to take a recurring lump sum so that you know every single month there's going to be a payment. I can rely on that and it can grow. Or that person can actually say, you know what, I don't need a monthly payment. I actually need to have a lump sum paid out. And that person can make that decision when they know what they need. They know financially what the circumstances are, and particularly on the disability side, they know what their prognosis is. So am I likely to still live until my retirement age? In which case, maybe I do want that income. Or, is it pretty bad? Have I got a number of months left to live? In which case, rather give me the lump sum. I'll take it from here. Give me everything up front, and I'll sort out with my financial planner how to make the best use of that for the people who need that going forward. So it was a great opportunity that we stumbled across in the market to bring this needs match insurance to the South African risk market as individual clients, but now also as group risk clients as well, and to those members. And yeah, thanks to the emergence of new technologies, we weren't able to do this many years ago. Where one size fits all solution was everything. It was a rate card, and you worked out your initial premium, your initial cover amount, and if you were lucky, that grew over time. Just isn't the case, and it isn't the best thing that we as an industry can do for our clients and our members anymore.
Lydia, all of this is very interesting, and I now get where the needs match thing comes from. Thank you very much for explaining that to me. And I think you guys are doing things a little bit differently. So I'd certainly like to explore this with you going forward. And thanks for joining me on the session.
Thanks, Chris. It's been wonderful being here, and glad that we could, as much as explain to you what needs matched insurance is, maybe explain to everybody else who's listening as well. Thanks so much.
Perfect. Take care.